Thanks for having us. So, I'm going to start with some just super quick intros, just so you have some context of who we are and why we're here. So, I'm a VC in this space. I've been deploying capital for about 10 years now. I'm on my third fund. And the topic of stablecoins is very relevant because when you raise a bunch of VC money, you have now this treasury, right? What do you do with it, especially if you're crypto? Do you diversify it through stables? Like, how do you handle staking and things like that? So, the topic is near dear to my heart. But not only do I deploy financial capital, I also deploy my time. I've jumped in full time now to help Wire Network, which is providing a universal liquidity layer, universal transaction layer in the blockchain space. And so, yeah, I'm really excited to be able to moderate this panel. So let's just go down the line and do some quick intros.
Thank you. Hi, everyone. I'm Lana. I'm with Glowdollar. And so the TLDR on us is we are a stablecoin. We're US regulated, 100% fiat backed. And essentially what we do, a lot like USDT and USDC, is we take that cash and we invest it mostly in short-term treasury bills. And so we, as a foundation, generate yield on that every month. And we take that profit and donate 100% of it to public goods and charities.
Hi, I am Yana Bertram. I run strategy at Brary Foundation. So we work in the NFT space, but as an organization, we run on stablecoins essentially. And we also hold our treasury that we do diversify and we actively look into yield making a fortune.
Hey, everybody. I'm Drew Austin, founder of Redbeard Ventures and Denari Labs. Really quickly, Redbeard Ventures is an investment house. We started as an AngelList syndicate with about 5,000 accredited investors, all investing in frontier technology companies, and namely blockchain, but also AI, robotics, space, climate. Then we have a managed capital fund that invests in early stage blockchain companies. We also started Denari Labs, and Denari Labs is a tokenomics consulting firm, also a token-focused accelerator platform. So, and we actually have an open and active accelerator with Wire Network right now. So if you are looking for capital and you're building on the Wire ecosystem, go to denarilabs.xyz, I believe, Denari Labs XYZ, and go apply, because we are investing venture funding $100,000 in top tier companies that are going to be building on top of the Wire Network and Wire ecosystem. So, and excited to talk about the topic today. Stable coins are a major part of the venture capital ecosystem. I think the magical word here is yield. I think that when we think about what crypto enables and programmable money enables, it enables yield opportunities. And I think when I think about the investment landscape around stablecoins, I'm constantly thinking about what are going to be the unique and new innovative ways to expand the yield-bearing asset landscape through stablecoins. And that's a lot of what I think about and a lot of what I want to see more of.
Yeah, that's cool. So a lot of my conversations the last 10 years or so around this topic have been actually very narrowly focused. For those of you that know stablecoins, usually it's around one or two different niche conversations in this topic. But what I love about these panelists is we are covering a very broad range of uses for stablecoins. So I'd like to start out by just talking about what were stablecoins originally, or even to today, what problems were they trying to solve and how are they being solved right now?
I would say, I think in the simplest way was to provide people with a stable payment system. So we love playing into the volatility and the speculation of token go up, but then token also go down. And when you're talking about managing large sums of money, and when you're talking about people being able to pay their day-to-day things, or you want to do cross-border payments, having a stable coin is really important. It's also why I, at least my opinion would be, you see most stable coins being US pegged to the US dollar, mostly just because most people do business in US dollar denominated. So it's an easy way to kind of bring the traditional financial market into the blockchain space in a way that people really understand.
Also like transactability, right? Because you have all these other currency. You actually need a common denominator when you're swapping around, and just having that stable coin, and especially we have like USDC as kind of a dominant stablecoin on this side of the planet. It just allows for that very fluid movement between all these different alt currencies.
Yeah, I think simply like we live in every day we are going into a more digital first society. Every day we are becoming more globalized. The geographical barriers don't necessarily exist in the same way in a digital world as they do in a physical world. And the idea of cash plays a major role in our physical world, and that cash doesn't really exist in the digital economy. And I believe that, stable coins were kind of introducing that concept first to the digital world, is how are we going to have decentralized and digital cash, stable payments across across this global digital society that we're evolving into. And then from there, it just opens up. I think programmable money is the concept that really comes to mind when I think about what is the purpose of stablecoin. That's kind of where I go.
Yeah, and it's also like interesting because like, the one I mentioned, USDC, right? It's pegged to US dollar, and a lot of them are pegged to a national currency, but they are very multinational by design, right? So you can be paying people in different geographies and they might be using different currencies, but you as an organization don't really have to worry about it, right? So if I was in the traditional system and I would be paying my international team members and vendors, I would actually have to like go through the efforts of like figuring what currency to be paying them in. And like now I can just pay everybody in stablecoins. And for me as an organization, it's so much simpler.
So for a little education for the audience, how do stablecoins work? Like, how do they actually peg to a fiat coin?
There's a lot of different types of stablecoins. Not all stablecoins are equal, and nor should they be. So some stablecoins like Glow Dollar, we are backed, or we're pegged to the US dollar by being backed by cash. So it's 100% cash backed. And like I said, every on-chain dollar that exists, it's backed by an off-chain dollar that is then invested. And that's where us as a foundation generate our yield, similar to USDC and USDT. But then you have yield-bearing stablecoins, which sometimes the yield-bearing stablecoins, again, the mechanics can be different, but they might have you mint USDC or USDT to mint this new stablecoin, something like OUSD. And then they, in the back end, are taking the USDT and the USDC and investing that into things like Aave, Euler, and then the holders are earning yield on that. You have ones that are algorithm backed that maybe RIP are no longer. And then you have some that are like Azos is a new stablecoin coming out. It's very focused on like climate action. And so you can, as an example, mint AZUSD on Base using Glow Dollar. So you would like lock up Glow Dollar, use it as collateral, and that would then mint this new stablecoin for you. That again, their profit goes to fighting climate action. So there's a ton of different types of stablecoins backed by different stuff. Just with using stablecoins, really look into and be critical of what is backing them. Are they showing proof of reserves? We show proof of reserves every month. We have independent attestation showing we have the amount of money we're supposed to have. So doing your due diligence too, because as we've seen, your stablecoin might not be stable and then all your money disappears, and that really sucks.
Just to add to that quickly, not all stablecoins are also backed by fiat. Like I'm seeing a lot of stablecoins now backed by gold or backed by various different types of real world assets. So I think that's another component here. It's like not only is, across the board, we need transparency and we need clarity and stability, but I think we're going to see a lot of different types of assets that are going to be pegged to stablecoins in the future.
Yeah, I think like that's a really important point, right? Like not every stablecoin is equal, not necessarily just because of like, whether it's backed or whether it's algorithmic, but also what it's backed by, right? So like, for example, USDC and USDT actually have a very different backing mechanism, right? One is kind of more stable, which is the USDC, right? Because it's connected to the US dollar to a much greater degree, right? And USDT makeup of backing is much more volatile, right? So I think as an organization or as an individual, you always need to like assess your own risk appetite.
That was an incredible, by the way, that was an incredible education lesson on stables. Thank you for the three of you. So, okay. So for finance people, CFOs in the room, CFOs, listening, watching any clips of this, risk, regulatory, right? If they're trying to diversify their treasury, how do you even approach this conversation to think about risk and future risk and the landscape around it?
I guess if you are an institution, it would be helpful to, I think you'd probably want to look at regulated stablecoins first. So USDC is a regulated stablecoin. I'm obviously biased. USD Glow is our ticker, but Glow Dollar, we are also US regulated. So, and we're issued in the United States. So the idea behind that is because Glow Dollar was actually born out of the Terra Luna crash and being like, is a really great opportunity to create a new type of stablecoin. So regulation, I think, is important. And obviously, depending on what your structure is, you might want a stable coin that's almost all decentralized, but then actually does have the ability to maybe prevent money laundering or things like that. So again, when you're a US regulated stablecoin, there are like certain components there that make it you more favorable to the US government. So depending on kind of the money systems you have set up, that would definitely be one way to look at it. But if you're on the other side, you want like a fully decentralized stablecoin, then you would want to look at something maybe like DAI or DAIX, or what is it? There's a DAI is now something else, but I can't remember what it is. There's a totally decentralized stablecoins where you can do whatever you want, and no one can ever shut it off. And then you have regulated stablecoins, typically US, means that there's some like back switch for money laundering and things like that. So looking at it, because certain regulators will favor certain ones over other ones, and even something like Glow Dollar. If you hold Glow Dollar, because we are a nonprofit organization, we can donate our yield wherever you would like us to donate it. And in certain situations, you can actually get like a tax receipt for holding Glow Dollar, even though we're making a donation on your behalf. There's like logistics in there where we're considered US regulated, but also that nonprofit component. So there's different things you can kind of look into.
Yeah, and I think like as an organization, it also depends like what is like the mandate that you actually have, right? So when I think about us and the foundation, we are on a conservative side because we have a mandate by the DAO. We are entrusted this treasury. It's not even like ours, right? Like it's the DAOs, and they ask us to diversify. So we're going to be conservative by default. So we go for the most proven, most stable, regulated backed stable coins, and we are also very conservative when it comes to how we want to be using them for generating yield, right? And we're also balancing that with transparency, so keeping everything on chain at the same time.
And I'll kind of maybe even take a different angle. Question is, I would also think about what is the whole ecosystem of infrastructure around this, around stable coins that are going to enable us to be able to have a safe, trusted environment to be able to invest in that and utilize these tokens, in a conservative. So what is the auditing infrastructure look like? What is the security infrastructure look like? What does the payment rails look like? So, not only as a venture investor, am I interested in, not only just being able to, utilize my stable coins and to put my treasury to work and earn yield, but as an investor, I'm also looking at it as, hey, we have to invest in the infrastructure surrounding this so that these stable coins actually can be transacted in a safe and trustworthy way. So I think that there's also that whole part of the ecosystem that needs to be considered and looked at when thinking about how to operate in a safe and transparent way.
So in the UST era, right, they were promising and produced 20% yield for a little while before it all collapsed, right? There's large cap, small cap stables. How can the audience members think about generating the most amount of yield, but being wary of the extremely large APYs that you kind of see out there? I have some nuanced questions around that, but I want to start with that.
I'll just jump in real quickly because one thing came to mind. There's going to be a lot of new yield earning opportunities. They're going to be coming out every day. There's a company we recently invested in called Peapod Financial, and they're basically providing, you provide USDC as a backing token, and they're providing yield earning opportunities by earning yield on the volatility of a token, because they've built out an automated way to earn on volatility across different types of exchanges, and you can leverage that volatility and earn yield based on that. And if you're lending your stable coins to enable people to borrow and provide more leverage, then this is another opportunity to earn real yield. I think that there's going to be so many fascinating ways that we are generating yield on stablecoins. I think I think about different components, like how will AI be paid for in the future? I think yield will ultimately pay for AI compute and different types of resources. I think yield will be utilized. Just making sure you all are paying attention. But yeah, no, I think yield is going to be utilized in all different shapes and forms. I think it's going to be utilized as pools to compete for in competitions and games and new ways to provide rewards and benefits and loyalty. I just think that there's going to be a lot of innovation happening that's going to create new mechanisms to generate legitimate yield. And I think right now we're scratching the surface because we're introducing these new concepts, but I think we're going to see a lot of innovation over the next few years in that area.
I'll also like add sustainable funding, right? As an ecosystem, right? And us safeguarding this treasury, the purpose of that yield is longevity of the operation. Longevity of the operation is sustainable funding of growth.
I think too, the saying is, if you don't know where the yield's coming from, you are the yield. And that's not a good thing. So get out. So I think too, like looking at, where is the yield generated? And you can do like yield stacking, right? So it's like Glow Dollar as an example. And same thing with USDC, except in Glow Dollar's situation, you're generating yield and that yield is being donated. And we have an app, you can like select where you want us to donate to. So we're generating yield on the back end by real world assets, but then you can take that USD Glow and put it into a lending market and earn your own yield. That's 100% yours because you're participating in peer-to-peer loans. I think for a lot of people, when I discuss stablecoins and geek out about yield, their eyes gloss over. And I think part of it is also because a lot of people don't think about yield because we're just so used to putting our money in a bank. But it's like banks take our money and earn a lot of yield, and they don't give us any of that. And so the idea is just by discussing yield more and all the yield earning opportunities, we're creating opportunities for ourselves to be our own banks and our own kind of like, as a community, we can access things that traditionally are only accessible to large scale banks and institutions. And now everyday people are able to go out and do these really cool things and earn money on their principal assets especially with stablecoins. You never have to lose your principal, which is really cool, especially for savings, especially for when you're doing like humanitarian aid. It's a really cool model because the 5% yield on a US dollar here might not be a lot in Canada, although the Canadian dollar sucks. But because I'm Canadian, so I can say that. But in the global south, that yield, that 5% yield on a couple of US dollars is actually a lot, and it can really sustain things. So I think too, as you were saying, we're really just scratching the surface in terms of where we can go with this.
And I would want to shout out Morpheus protocol because I think Morpheus introduced an entire new kind of almost way to bootstrap early stage venture. So, if you're not are you familiar with Morpheus? Is the, raise your hand quickly. But like, so, sure. Yep. So Morpheus, I mean, it's a perfect example of by utilizing, staking, let's say Ethereum, for example, you are staking Ethereum and providing the yield to a given startup, so like Morpheus, and earning Morpheus token in exchange. They collect the yield from that to give them the bootstrap capital to be able to operate and build and experiment and create startups. That to me, and they're now enabling that infrastructure for all types of companies. So now I could take my More token, I could stake my More token, and I could then earn other early stage venture tokens by providing those tokens and providing them access to my yield. I mean, that is like the most interesting way to invest in early stage venture. I mean, think about taking the risk, almost your risk capital out of early stage venture investing and just providing you're able to take back your principal, and you've just provided the yield and then now have an entirely new asset class with massive upside at your disposal. So I think that's a really exciting example of how yield can open up all different types of new opportunities and new businesses.
But so as a follow-up question, how does it scale, right? Because the algorithmic ones with UST, for example, somebody just did like a $8 billion thing and then it depegged and everything crashed and burned. I love the reality of if there are clever real-world assets being used to provide that yield, the transparency in that for the holder of a stablecoin sounds pretty cool. But I personally have been pretty freaked out by putting too much into these because I don't know how it scales up at that level.
So regulation is so important. I mean, you guys are much closer to this than I am in that regard. But, this is why we're all looking for regulated stable coins, because there needs to be rules and transparency. I mean, these are supposed to be the conservative assets that allow us to enter the digital economy, so that there's logical regulation that should be needed. The ability to show proof of reserves. That's the most obvious thing that any stable coin should have a default. That should be default for any stablecoin that exists in the world.
Any other comments, Grace?
Like you have that with fiat as well, right? Like no fiat is like 100% backed. So I think like, the same logic will apply on stablecoins as well. So I think like there's a level of trust, right, in the robustness of the system right? And I think robustness is a very important word here, right? Like if you have like a very low volume stablecoin that is like backed by even like lower volume, and if things do pick up, it's not sufficient. And like that's where I like 100% agree. Like regulation is super important, right? Because it does provide an approval stamp essentially by a lot of people who invested a lot of hours of research and vetting, right? That are way more than an individual can be doing. So I think it's just, good for the everyday user. We say, do your own research, but like when we're talking about mass adoption, that's not really sustainable, right? So there needs to be shortcuts for people to be able to lean on, and regulation and certification is probably like the most direct way to get there.
It is very hard to be a U.S. regulated stablecoin, and there are a lot of rules and like laws around it. So, I mean, I can speak from Glow Dollar's behalf that it would have been easier for us to spin up an entity anywhere else in the world. But we chose U.S. for the reasons of because regulation is hard. So people also tend to trust U.S. regulated stablecoins a little bit more. There is a lot of strictness in showing proof of reserves. We are real world asset backed. So I think it's just doing your research and then, also recognizing nothing is ever too big to fail. And just like asset diversification and any type of investment portfolio with stable coins or any type of token, just diversify, hold different stable coins, hedge your risk that way as well.
Love it. Okay, last question. We talked about backing with real world assets. We talked about clever sort of yield strategies with the real world assets. What use cases are you all excited about for what the future could hold for the space in this stablecoin areas?
Again, I'm biased because I'm with Glow Dollar, but I think that our use case, so even before I started working with Glow Dollar, was really into their concept, because the idea is that Tether, so USDT and Circle USDC bring in tens of billions of dollars every single year on profit from the assets backing their on-chain dollars. Those are that's money and yield that the end users, like the holders of USDC and USDT, they don't see that. So it's just being paid out to shareholders. And so with Glow Dollar's model, the idea is, well, what if we could take a fraction of that market and take hundreds of millions of dollars, if not billions of dollars, and donate those to really important causes? And then we're able to create this new sector of philanthropy where essentially at the end of the day, you're able to fund things that you care about through using digital dollars that are, again, asset backed. And you can fund cause areas that are really important to you because we have an app and you get to select. But you, as the holder, never actually have to make the donation again. So simply by adopting a different type of stable coin, you're able to fund things that are really, really important to you, and that can scale. And so our big goals are, that's a way for us to eradicate extreme poverty, support climate action, again, create new funding models for important cause areas without individuals or organizations having to actually make the donation themselves.
Love it.
Yeah, and when we talk about stablecoins, most of the narrative is about cross-border payments, right, and access for the underbanked. I would add to that, even organizations, not necessarily just the big ones, right, that are trying to save on processes and speed and have big savings by the fact that there's 99% drop in wire transfer settlement, right? Because actually payments are instantaneous, or that actually you would save hundreds of millions of dollars on a monthly basis, right, for actual payments done manually, right? Because now things can be programmatic. So there's very obvious benefits to large companies, but even for small orgs, right? You don't have to worry about having a bank account in different jurisdictions. You don't have to worry about managing multiple currencies, and that element of I actually can run a business without needing to figure out how to open a US bank account if I'm an offshore entity, right? That is such a simplification of operations that is just making things possible in a way that they were not before.
I'd like to see some for example, I think one idea that I'd love to see executed on is a reinvention of insurance, for example. So can the yield from your principal pay for, cover the insurance costs, and only if an event takes place is that yield then utilized to cover insurance situations. I'd love to see new reinventions of models where people can use their principal but always get out, like, how much money we pour into insurance, and that money often goes nowhere that we ever personally or benefit from. But if we can just provide the yield from our principal and always get that principal back, that's just a really powerful way to be able to fund insurance programs, and use event-based triggers to distribute yield in a regard. So I think that also another way I think that's going to be really powerful. We're going to also see a lot of like yield optimization, like AI yield optimizers. So the ability for us to just say, hey, here's my principal, figure out the best, here's my level of risk. I want you to optimize my yield on a day-to-day basis, on a minute-to-minute basis. Where can I maximize my yield based on my risk profile? So I think we're going to see a lot of that, and that's going to come into play. So there's just a lot of opportunity.
Yeah, but with trillions of dollars coming into stables and real world assets, and digitizing it, it's going to be massive. So thank you all for this extremely insightful panel.
Thank you. Thank you.